Give us this day our daily bread.
Vix! Our daily Vix, that is. Welcome to the Short Vol Show Live. My name is Dave, and we are coming into a Monday morning. Let's go straight to the stats, and then I'm going to give you some ideas of how to short the VIX. All right, so right now, the VIX is 1388. We are in contango of over 7%. There is some weekend in effect going on here. Why do I say that? Well, if we look at the VIX right now, if we look at the stats, the VIX is up 16 cents. However, all the futures are down a little bit. This is due to weekend effect, and you'll see this a lot on Mondays. And what it is it's a sort of tracking error in the formula for the VIX, where it doesn't take into account the it's like the 7-day work week versus the 5-day. The 5-day work week versus 7 days in the week. It tracks kind of weird, so that you'll find that on Friday afternoons, the VIX is suppressed more than it quote-unquote should be, and on Monday mornings, it's a little bit higher than it quote-unquote should be. And this pretty much happens every Monday, every weekend, just due to this sort of tracking error. So you kind of have to discount the price of the VIX a teeny bit every Monday because of this. And sometimes people will catch on to this and write an article about it or something, saying, oh, you know, this is manipulation or this and that. But it's not manipulation. It's just tracking error on the VIX. Anyway, so we have seen contango building. Let's go to VIX Central and take a look at the chart real quick. And like I said, I want to get to the part where I explore different ways to short the VIX, but I just want to do the numbers first here. All right, so we can see in the chart, which we can't see because I'm in the way, this is the term structure, and the first 2 points on the chart are the most important, of course, because those are the only two that actually matter in the pricing of UVXY or VXXB. All right, so if I pull out my pen here, these 2 points are the only 2 points that matter. And right now, the VIX is an average of these 2 points. And it's not just one-to-one average. The average changes every day depending on where we are in the expiration cycle. So if I pull up the ProShares website, ProShares is the company who administers UVXY. If I pull up the ProShares website and look at the daily holdings, we can see that the VIX right now is composed, or I'm sorry, UVXY is composed of a mix of 2 futures, a swap, and a cash component. So the swaps generally will be based on either just simulating how the UVXY should work. It's just written up. We're going to make something that will simulate exactly the way UVXY will work. But the reason they use a swap is because it saves them margin money. Or a swap could be just following one future or the other. But when you look at the website, you will notice that as far as I've tracked it, the proportions of the 2 futures involved will always reflect exactly what they should be as far as where we are in the expiration cycle. So you see here the notional value right now of the futures in this calculation is way higher than the swaps. That's not always the case. Swaps come into play and will be used by ProShares in different ways over time. But I tend to just ignore them because I know that the calculation will be the same as if the swaps weren't involved per the formula in the prospectus for the fund. So without getting too deep into all of that, right now we have a UVXY that's composed of the March future, the April future and the May future. So we have April futures 28,000 and May futures 21,000. So it's close to 50-50 of both of these futures. Now every day as we rebalance till expiration, And expiration is on the 17th of the month here, which is about 3 weeks away. So a little bit over 3 weeks away. So every day as we head towards expiration, a percentage of the front month futures, that being the April, are sold and replaced with the second month futures, that being May. So if we go back to our VIX term structure, a percent of these, and let's pull up back my pen up here, a percentage of these first month futures are sold every day and rebalanced by buying these these May second month futures. And as these are replaced, the cheaper price ones are replaced by the higher price ones. It gives more room for these all to fall towards spot. So everything's falling towards spot every day. But as we rebalance, it gives more room for these to fall towards spot, and thus gives more room for UVXY to move lower and lower over time. People often ask, when they look at a chart of UVXY like throughout the years, well, if UVXY has fallen so far from, it shows on this chart, 11,000, couldn't there be some big spike that got it back at least to, like, I don't know, 200 or 500? And the answer is not really. And the reason for that is because the makeup of UVXY is always changing. Yes, this fund has come from that level, but the futures that represented prices of that level have long since expired and come off the sheets. When we go back to our chart here, these futures, these April futures, will fall off in 17 days and they will no longer exist. And so, yes, you could have a spike where the current futures go way up, but you can't get back to the futures that were way, way higher a long time ago that no longer exist. They're gone. And so there's no way for this to go back up to those heights. The only way it could go back to those heights is if we went into backwardation where the futures pointed the other way. Remember, backwardation is when the futures are going sort of downhill instead of uphill. If the chart looked like that and we were replacing a higher price future with a cheaper one for an extended period of time, then the curve could turn around and start to head up a little bit. But the problem is that it can never get as high as it was before, because the market would have to, like, crash and go negative for volatility to stay that high for an extended period of time. So basically, mathematically, this is destined to always head lower. And it's funny because when we do have extended periods of backwardation, people get all excited in their heads and these notions that, wow, maybe this thing could turn around and UVXY could turn around and head back up. And it can for a little while, but only for a little while. So we see this pop in December. If we go to the 3-year, well, it's hard to see in the 3-year, but if I cut the 3-year in half, so here's a year and a half, you can see we've had a couple big spikes where it did turn up. But you can see, even with it turning up, there's still pressure pulling it back down all the time. But, you know, in these periods that we had where it's moving sideways to up, people get all twisted and think, wow, maybe this thing can go back up again and continue to move higher. But really, mathematically, it just can't happen. All right, well, I hope I haven't confused you too much with this technical stuff, but I hope I can just convey a little bit of how this works for you, at least a little bit of it at a time. And so now let's go on to some strategies to short volatility. One way that we've looked at it recently was to come up with a strategy, and then once we've come up with a strategy, to look at the Greeks, the options Greeks associated with that strategy. Now, some of the Greeks we've gone over before are Delta. Delta is the most basic one, the one that people learn first. Delta is the dollars you would make for a $1 move in the underlying. So if you're have 100 deltas, and like a 100 delta option, which would be a deep call. If the stock moves up $1, you would make $100. Long 100 share. If you own 100 shares of a stock, that represents 100 deltas. So if you own 100 shares of a stock, goes up $1, you make $100. Goes down $1, you lose $100. The other definition for delta is the hedge ratio. So deltas help you compare options to stock. For example, if you have an at-the-money option, if we look at UVXY trading 38.50 right now. So if you have an option that's right around the 38 level, 38.50 level, let's take this April 35.5 call, that's going to have a 50 delta. So it represents, with stock right here, represents the equivalent of having 50 shares of stock. And if you bought 2 of these calls that represent a 50 delta, you would sell 100 shares of stock against them to hedge them neutral. So that's the hedge ratio. And the third definition of delta, which I've already kind of implied, is the stock equivalent. So, for example, let's pull up our deltas here. On the side of this chart here next to me, if I move out of the way for a second, you can see this first list is the delta. So if you have a stock, if we look at the 40 call, for example, it says 40 delta. Now it says 41 delta. So the equivalent of buying 140 call, if you were to convert it to stock right here, would be, if you bought one of those calls, it's the same thing as having 40 shares of stock right here. Its delta is the same as having 40 shares of stock. So you can kind of convert what your option position is to how long or short stock you are. That is the third definition of delta. Now, I'm not going to go into defining all of the Greeks right this moment. I'm just going to assume for now that you understand the Greeks. The point I wanted to make is we can make a strategy and then look and see what the Greeks are on it. But another way of coming at putting on a position or getting short the VIX is to start from the point of the Greeks and say, well, I want to have such a position with the Greeks. For example, I want, if I'm trying to short volatility, I want to have a short delta. That's pretty much given. But we might want to make decisions about the other Greeks as well. For example, we talk about theta. Theta is how much your position costs you every day. Now, ideally, we would like to have a position that paid us every day, of course, right? But it does come down to how much risk we have to take to be paid every day. When we look at UVXY, if we were to compare it to a stock, it's not a stock, but if we were to compare it to a stock, you could objectively say that it has a high volatility compared with most stocks. So if we look at the options volatility per month, if I look on the right side, if you look to the right of my head here, you see it shows the month's average volatility per month here. It shows 90%, 87, 85, and this gets in a range. It can be in the mid to high hundreds at times also, but 90 vol stock is pretty high for stocks, and so but to make a decision of whether you should short or long volatility is more than the scope of what I want to cover here. But the basic sense is that if a stock moves more than the volatility of the options, you want to be long the options. If it moves less than the volatility of the options, you want to be short the options. And generally, the options for a stock will be priced around accurate for how much the underlying moves. That all being said, if we make some assumptions about UVXY, one, that it's slowly going to move down so that we want to be short it. We're talking about shorting volatility here. And two, that we don't know when it's going to move down, and thus we're going to have our short on for a period of time. then we might deduce that we want to be collecting money every day. So we want a position that's short delta and long theta. And to be long theta, we probably want to sell options. And so we can come to a conclusion that we want a position that's short delta, short gamma, and thus long theta. So once we decide what Greeks we want, what sort of Greeks we want, then we can start to put a position on that has the Greeks that we want, and that's another way of going about putting a position on, starting from saying we want these Greeks on. I want to be short X amount of deltas. I want to be collecting X amount a day. I'm willing to take X amount of risk for a move of a 50% move, let's say, and then construct a position that has those Greeks. That's kind of a different way of coming to a position than saying, okay, I want this particular strategy. I want to be short call spreads, or I want to short the stock, or I want to buy puts. You can construct a position that has the Greeks you want, and if it has the Greeks you want, it really doesn't matter so much specifically what the position is, because it's defined by the Greeks. So in this case, I was talking about maybe having a position where you are selling at the money straddles or selling strangles, but in such a ratio that you are net short deltas. And I will go into how we can do this moving forward, but this is just to kind of put that idea in your head, and we can talk about it more as we move forward. All right, so it was funny. Last night I was looking on the Sunday night, and I saw that the major indice futures were rallying, and so I knew that the VIX would come in today. The VIX is held pretty solid right now. In fact, VVIX is up 74 cents. VVIX around 86 right now, which is pretty low, I would say. But even with the E-minis up a lot, the VIX is maintaining pretty solid right this moment. I mean, it's not even down on the day, with E-minis up 24. So staying pretty solid, which isn't completely surprising to me, because the VIX already is at kind of a low level. But this fits into a short vol position great, because we're in such a level of contango right now. We're in 7% contango. So if we take 7% contango and we multiply that by the stock price, so 0.07 times 38, we get 266. So UVXY decaying, all things being equal, by $2.66 a month. That is some serious decay. So even if the VIX just stays where it is, this thing is decaying before our eyes almost right now. All right, so there's your daily VIX. If you didn't understand everything I was talking about, don't worry about it. It will become clearer. I apologize for maybe not the clearest way of explaining some of the stuff, because I kind of came up with it on the fly. But time will help you to make things all clear. Things will become clearer over time as you dig into the VIX and these concepts. Thanks for watching today, folks, and I will see you in the next one.